Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio, how it's been performing by the metrics, of course, our buying power, what we have left over from our purchases last month. Then we're going to take a look at the individual holdings, starting with Realty Income, and see where they're at, whether they're buys, whether we're just going to hold them. Take a look and see what is going to be paying us dividends and at what amount. And then I'll talk about where I plan on putting that dividend income for the next month, as well as what is on our watch list, being Berkshire Class B shares and Meta Platforms, formerly known as Facebook. And I'm going to talk about what prices I want to buy these at and where I see them in the overall lineup of the portfolio. So jumping right in, guys, for today, we are down about 20 bucks. So I'd say about break even, down 0.04%. Not a big loss, but of course, fluctuation is the name of the game. So the overall performance and cash, of course, the value of the portfolio is going to fluctuate because it's 12:50 in the afternoon, so the market's still open. But for the 1 week mark, we are up $446 with a near 1% return. That 1 month mark, we are up $125, about a 0.25% return. 3 month mark, we are up $1,000, right around $1,700, with a about 3.4% return for the past 3 months. Year to date, we are up $1,800, up a 3.6% as of right now, year to date. Then that 1 year mark, we're up $2,800, with a 5.8% return for the past year. And then, of course, we've got all time since, I believe, April 2nd, of 2018. So about 6 years of investing here. We are up $16,294.21, a 46% return. So guys, right now we're sitting at $51,633. Of course, that's going to fluctuate because, as I said prior, the market's open. But in the short term, it's a voting machine. So all of my companies, whether they're reporting earnings, they have news stories, whatever it is, they are all going to fluctuate, and I have no control. I have no way of knowing where that's going to go. Right? So in the short term, the market is a voting machine. People vote on whether or not they think the stocks are going up and down based upon like short sellers. You have day traders. There's a lot of activity, but I'm not that type of investor. I'm focused on the long term. And in the long term, the market is a weighing machine, which means in the short term, anything can happen. Everybody has it's all emotional tie-up, right? It's an emotional hurricane within the stock market, and there's no way to predict it. There's no way to control that. You just have to let it go, like Disney's Frozen, and take advantage of mispricings and overreactions. And that's really the beauty of it too, is if you are a short-term investor, most of the time you lose out on good profits because the money is made long-term. So in the long term, it's a weighing machine, guys. So if I own quality companies that pay growing dividends and they grow their earnings at a clip faster than they're growing their dividend, and they allocate capital wisely and they do share buybacks, I'm going to make money over time. And I want to find some of the highest quality companies. Not all of them in my portfolio are, and I understand that, but I want to find quality, high quality companies that have a competitive advantage, or a moat, as Warren Buffett calls it, that reward shareholders by buybacks and dividends, primarily dividends, but I do like buybacks as well. And year over year, they can grow that cash flow and reward me as a shareholder. And then I'll use that money to buy more shares of quality companies that are on sale. So just because something like AbbVie pays me a dividend does not mean the money's going back into AbbVie. Just because Apple pays me a dividend does not mean it's going back into Apple. I would rather, instead of doing dividend reinvestment, because some of my positions are really high right now, I would rather reinvest it where it makes sense, the most sense in the portfolio. So that doesn't always mean that dividends are going to be reinvested back into a certain company, but the dividends are always reinvested back into the overall portfolio. So as of right now, the buying power is sitting at $28.76. Guys, we get paid dividends every single month, so that will obviously be going up. I know AbbVie is paying us, and I know Realty Income is paying us. So I know that amount is going to go up. And that's what really makes me excited about this portfolio, is I know some of the positions I'm looking at don't pay dividends, but the capital that I already have allocated is growing, and the dividends are growing, and the stocks are doing well. So I know my income is going to go up year over year, even quarter over quarter sometimes, because of the stocks that I've picked. So jumping right in, one of my personal favorites, Realty Income, is sitting at $54.41. Here, I'll go ahead and turn mobile data on real quick. There we go. So it's sitting at $54.40, 170 shares, $9,200 worth of market value. Average cost is $65. 18% of the portfolio is in Realty Income. Then we have a loss today of $67. And total, we're down $1,800 with a 16% loss. Guys, this has been as high as like I think a 20% loss. And I'm not worried about it. I get paid every single month. I look at this as I am a real estate investment owner. I own the properties through Realty Income, and they give me some of that cash and pay me monthly like I was a landlord. I just don't have the headaches. I don't have leaky faucets. I don't have toilets. I don't have to repair a roof. I don't have to go through and worry about a water heater. Like, there's so much unknown about real estate investing because I'm not in it personally. So I would rather let a company deal with that and just take the cash flow every single month. And that's what Realty Income allows me to do. But guys, this right now, I believe, is the best deal within the portfolio. I'm about $10 below my average cost. So I could, put some cash into it and really lower that cost basis. So this is where I plan on putting money, unless something like Google or Visa drops. Then I will, of course, put that ahead because I'm trying to grow those positions. Realty Income is already near, $9,000 to $10,000 and 20% of the portfolio. So like a fourth of my money is in Realty Income. So I'm trying to diversify and, get a couple more companies into a bigger position. But if this is a better deal over those options, I'm going to put it back into Realty. Then we've got Altria, guys. This is my highest paying dividend stock at $44.62. We've got 320 shares, $14K worth of market value. Average cost is $47.27. About 28% of the portfolio is in Altria. Today we're up $107. Total, we're only down $800 with a 5.6% loss. Guys, this has been as big of a loser as Realty Income at some point. So the fact that we're only down like less than $1,000 is awesome. It does provide significant cash flow for the portfolio. In fact, Altria's dividend is what bought that share of Google and that share of Visa. And that's exactly what I want Altria to do. Altria is going to be the cash cow of the portfolio. Now, I might not be putting more money into it simply because it's already such a big position. It's already nearly 30% of the portfolio. And I understand that it's a declining business, but I think there are some advantages to owning big tobacco. One, I've used it myself. So I've put money into this business. I want to get some money out, and I want to be able to allocate capital effectively using Altria's dividend. I'm going to be buying stocks like Google, Facebook, Berkshire, and Apple when it makes sense. And I wouldn't be able to do that right now if it wasn't for Altria. So I'm grateful for the position, and I'm excited to see how much we can buy with Altria's dividend. Next, we've got CocaCola, which is up about 20 cents today. We've got 15 shares, right around $950 of market value. Average cost is around $61 per share, so we're up just a little bit here. 1.83% of the portfolio is in Coca-Cola. Today, we're up $3. Total, we're up nearly 40 with only a 4% return. So, guys, I would buy Coca-Cola at these levels. I'd buy it all the way up to like 65. So I would still be purchasing here, even though I'm up about 4%. I do want Coca-Cola to be one of the big pillars in the portfolio. I want it to go Apple, Visa, then Coca-Cola, then Google, and either Berkshire or Facebook. I feel like that one could be interchangeable simply because both of those companies, I like them both. So I do want Coca-Cola to be one of the big pillars in the portfolio, and I'm excited to be adding more to it when it makes sense. So right now I would add to it. So once AbbVie pays me the dividend of like $140, I will be able to buy like 2 or 3, I think. Yeah, with the Realty Income dividend, I could buy like, 2 or 3 shares of Coca-Cola for free and wouldn't even have to put any new cash into it. So I will be adding to Coca-Cola eventually, but right now Realty Income is just a better buy for me within the portfolio. Then we've got Apple, which is up $1.76. We've only got 1 share, so of course market value fluctuates a little bit, but the share count is of course only 1, so my market value is going to reflect the price of the stock. So I only have $184 of market value since I only have that 1 share. 132.66 is our average cost. 0.36% of the portfolio is in Apple. The funny thing is, too, I looked at it. CocaCola has about the same return dollar-wise as Apple does, but my return's way better on Apple. Only 0.36% of the portfolio is in Apple. Eventually, I want that to look like 36% or maybe even 40%. I want the majority of my portfolio to be in Apple. But we're up $1.75, right around 1% right now. Total, we're up nearly $52 with a 39% return on Apple. So, guys, this will be the biggest position in the portfolio. I know the dividend's not big, but Altria and I think AbbVie pays the same month as well. So AbbVie will provide the cash flow. And eventually, if the dividend keeps growing as it has been, I think AbbVie will be able to reinvest into a share of Apple. But I still have other options. I can still, of course, put more cash from a paycheck into the portfolio as well. So I love the fact that I have dividend income buying shares of high quality companies every single month. The issue is I love Apple. I think it's one of the highest quality companies in the world. I just want to buy it near my average cost. I don't want it to go up $50 a share. Then we've got AbbVie at 160. Crazy that AbbVie and Apple are getting kind of close in. When I bought it, Apple and AbbVie were pretty close in dollar value. 95 shares, stock sitting at 160.50. 15K worth of market value within AbbVie. Average cost is $95 a share. Around 30% of the portfolio is in AbbVie stock. Today we're up $5. Total, we're up $6,200 with a near 70% return. Total on the stock, as well as a dividend coming in May 15th of $147.25. So, guys, I will have around enough cash to buy a single share of Apple with AbbVie and AbbVie and Realty Income's dividend. So the goal is still there, but usually I try to buy the next month's stock with this month's dividend. So AbbVie and Realty Income would buy T. Rowe Price or Visa if it is a good purchase for me, or even Google at that point too. But, guys, I've gotten a lot of questions just about some of the bigger positions. I love AbbVie, guys. I'm not going to be selling it unless there's a major change with capital allocation or that dividend payment. I love AbbVie. It's been the best performing stock. I actually bought it right around the time Buffett sold out of it, which I thought about selling out at that point. But I'm like, you know what? I think the Allergan acquisition is going to work really well in the long term. And I've been compensated really well for it. So that by far has been AbbVie's been by far my best performing investment thus far. Next, we've got Visa at $277.05. I've got one share. Market value, of course, is at $277.05 because I only have that single share, just like with Apple. Average cost is around $270. 0.54% of the portfolio is in Visa. That's going to be a lot bigger. Eventually, I want Apple to be, I'd say, like 30 to 40%. I'd be happy with Visa being 15 to 20%. So this will be a big position in the portfolio going forward. Today, we're down 19 cents. Total, we're up $8, nearly $9, with a 3.2% return. So Visa is one of those companies I've wanted to own for a long time, and I'm glad I finally got to buy it with dividends. Then we've got Google at $170.65, right around the same price as Apple, actually. But we've got two shares at $341.34 is our market value. Average cost is $161.14. 0.66% of the portfolio is in Google. Today we're down 95 cents. Total, we're up $19 with a near 6% return on Google. So, guys, this is going to be in the top 5 positions of the portfolio as well. I would be happy if it was 10 to 15, maybe even 20% of the portfolio. Just going to be patient, keep accumulating shares, and using those dividends to reinvest back into Google. And Google did actually announce a dividend of, I think it was 20 cents per share. So even though it's not huge, it is right around the same dividend that Apple has been paying and increasing for, I think, like it's been 10 years that Apple's increased its dividend. So Google's following in the steps of Apple, and it pays $369.12, so it'll be nice to get a little bit more cash flow in that set of months. Then, of course, we got T. Rowe Price right around my average cost here at $110.76. We've got 100 shares. I love that share count. It looks so nice. But average cost is $109.73, so we're about $1 above our average cost here. 21% of the portfolio is in T. Rowe Price. Today, we're down $72. Total, we're up still about $100 with around 1% return. So, guys, T. Rowe Price is where I would be putting that dividend income from AbbVie if it stayed around this price and if Realty Income was not as good of a deal. So I might even split it. I might buy 1 share of T Rowe and 1 share of Realty, depending on where the prices are at on the 15th. But then we're going to take a look at our watch list. So Berkshire B, guys, is one of my favorite companies simply because I love Buffett. I love Charlie Munger. I really do think the succession plan that they have in place is going to work really well. They are CEOs that have ran Berkshire companies. Ajit Jain has ran the insurance companies for, I think, about 5 years. He's been in the insurance companies for decades. Greg Abel ran the energy segment and did a very good job with that, and has been mentored by Buffett for the past few years as well. So they've both really grown up and lived in that culture for decades, and I think they picked really good successors. Greg Abel's a good steward of capital, and he's shown that within the energy business. Ajit Jain, I think, is like the best insurance underwriter in the world. He's ran the companies very well and has even done some innovations that nobody else has been willing to do in insurance as well, which Buffett talked about in the past couple of annual meetings and shareholder letters. So I think overall Berkshire's in really good hands. I think that we might see a little bit of a shift in the types of investments that they make. Less Kraft, Heinz, American Express, and CocaCola, like less consumer products. And I think more maybe insurance, given Ajit Jain's influence, and maybe some more tech, because Todd and Ted, the other people that invest money for Berkshire, they have invested in more tech-friendly companies like Amazon, Snowflake, and they did push Buffett towards looking more into Apple as a consumer products company versus a technology company. So I think we might see a little bit of a shift in what they invest in, but not how they invest. That's the real important part. I think they might change what they look at when it comes to deals, and they will be a little bit more broad when it comes to their understanding with technology and other opportunities within the market, maybe more internationally, and a lot more energy and insurance-based investing. But plus, they will have Todd and Ted looking at some tech-focused companies as well. So that I think that broader opportunity might help Berkshire in the future be a little bit more profitable and diversify the businesses. And they might even be able to buy full businesses and subsidiaries that Buffett wouldn't even look into, simply because of their wide and more diverse skill set and knowledge within the market and running those businesses. And guys, the real reason that I love Berkshire is because I love insurance. I love Geico. I love National Indemnity, Wesco, even Gen Re and reinsurance companies. I've done extensive research and I understand underwriting and insurance companies and how they work. I just don't want to own an individual insurance company because I don't have the confidence that they are not overly exposed. A lot of times they get bit when it comes to underwriting, even if they do a really good job. Sometimes there's claims that come up that they aren't expecting, and I feel like Berkshire is the best insurance company, has the best insurance company within itself because of the outside cash flow. So companies like Travelers, Chubb, Allstate, Hanover, Lincoln Financial, a lot of the public companies, they only get their money from insurance, which is fine. It's a good business if you understand underwriting. But the problem is when they have a big catastrophe, they might not have enough in reserves and investments and the cash flow from those investments to cover those premiums. And they can get bit and actually have an underwriting loss, which Berkshire has a couple of times. But one of the reasons that I love Berkshire so much is simply because they have other forms of income. They're not just insurance. That's a really big portion and one of the most important businesses that has helped them scale as much as they have, because they've done very good in underwriting. But they have subsidiaries. They have companies like See's Candy, Acme Brick. They have Gen Re. They have Flight Safety. They have Wesco. They have National Indemnity. They have Geico. They have Pilot. They have Dairy Queen, and they have Lubrizol. They have so many different companies. NetJets. They have all these companies that are under the Berkshire umbrella, and they help bring in cash flow, as well as, of course, the Apple, the American Express, the Coca-Cola, the Chevron, all the public companies Buffett and Berkshire own within their publicly traded portfolio, they have the stocks that they own, they have the companies that they own, and they have underwriting profits and investments. So that's why I like Berkshire so much, because of the diversification within the business being a conglomerate, and the fact that they're not solely dependent on one income stream to cover those losses if they don't underwrite as accurately as they think they do. So that's why I love Berkshire, and that's why I want to own it. And honestly, guys, I'd buy it at this price. I just want to do exactly what I did with Visa, purchase a share and cost down average. And I guess I could say the same thing for Meta, guys. $500, that's a little steep for me. I don't think it's worth that amount, but I do think over time I will get a good buying opportunity, guys. There has been multiple options to buy Facebook in the past, 5 to 10 years. So since I've been investing, it's been as low as like 56 at one point. I think that was the Cambridge Analytica scandal, as well as the metaverse and them spending quote unquote too much money on it, even though they have a huge cash pile and need to invest it anyway instead of sitting on it. Because treasuries were not at 5% before, they were at like 3%, so they wouldn't get as much even if they did that. But it was down to $90, so you would have almost 5 extra money in Facebook. So I saw the opportunity. I even talked to my girlfriend, my mom, my roommate at the time about it, and I was dumb and didn't buy it. So I want to get into Meta, and then I just want to cost on average. And then, just like I said with Apple and in the past couple of videos, I want to be able to have a cash pile of like $10,000, say like specifically for investing, and then put like $5,000 into Meta and $5,000 into Apple when it makes sense, or Visa, or whatever opportunities that I can see that I think are really good undervalued opportunities that are gonna give me like an AbbVie or a possible T. Rowe Price like 50+% return plus dividends. That's what I want to do. So, guys, with that being said, I just want to say thank you so much for watching. I did realize that I posted 2 videos yesterday, and I apologize for that. So I actually did, today's Thursday, so I did Wednesday's upload, and then I did Tuesdays on Tuesday night, and I was off work that day, and I just forgot to click public on the video. So I do apologize for double upload yesterday. But I just want to say thank you so much, guys. I've been getting subscribers every day, views every day. It really makes it worthwhile to keep posting videos, and it keeps my head up on bad rainy days and stuff like that. So just know that I'm appreciative. I'm excited to share my journey, and I'm grateful for every comment, every like, every subscriber. We're still a relatively small channel here on YouTube, and I love that because it still allows me to like respond to comments and get to know people one-on-one. So I'm so grateful for the community here, and I just want to let you guys know that I'm grateful. So thank you so much for watching, guys, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.